If you're here, I know you're tired of inconsistent profits and missed opportunities. You've heard it all before. Price action, indicators, keep it simple. Yet, you're still not seeing the results you want. So, what if I told you there's a framework that top traders use, something I call Market Trinity? The 3 V's of trading that could make anyone a consistently profitable trader, along with 7 powerful metrics to help you master them. You're not going to hear this in the usual trading videos online, but today I'm going to show you exactly why you're struggling and how mastering these key metrics could turn things around. This isn't a quick fix or just another hack, because trading isn't about finding shortcuts or copying someone else's winning system. It's about understanding the foundation of the markets, the forces that truly move price. If you're serious about becoming a profitable trader, keep watching. So, I've been trading for 9 years, and I know the feeling of struggling to find a reliable edge in your trading, or feeling like something's been missing in your strategy and your approach. So you're definitely not alone. The truth is, most traders fail because they don't understand the deeper forces driving the market. I'm going to show you a different way to think about the market, something that top traders use to consistently pull profits. These forces, or what I call the 3 V's, are the keys to unlocking your potential as a trader. They are volume, value, and volatility. These 3 V's represent the mind, body, and soul of the market. First, let's talk about volume. Think of volume as the soul of the market. This is what's actually happening behind the scenes of the chart when orders are placed. It's what gives life to the price action we see. Without volume, there's no movement, no change in price, and without it, there's no opportunity to profit. Next, we got value, the mind of the market. Value is all about what the market participants collectively believe something is worth. This is where things like supply, demand, and investor sentiment come into play. Understanding value helps you see where prices are likely to head next, and it gives you a mental map of the market. And finally, volatility. Volatility is the physical manifestation of what's going on in the market. It's the action we can see, the price swings, the highs, the lows. Volatility tells us how much energy is in the market, how the soul, volume, and the mind, value, are interacting and affecting price movements. So, here's what we're going to do. I'm going to show you exactly how Market Trinity work together to create profitable opportunities in the market. And I'm going to give you 7 powerful metrics to help you master them. By the end of this video, you will have a much clearer picture of what's really happening in the market and why so many traders are missing out on consistent profits. So why does Market Trinity matter so much? Here's the thing. One of the biggest reasons most traders struggle with consistency is because they rely too heavily on subjective approaches. They're laser focused on price action, candlestick patterns, trend lines, and support or resistance levels. But price alone doesn't tell the full story. While price action strategies can work, they demand an elite mindset and psychology because of their inherently low strike rate. That's why when you hear traders on podcasts, they're always emphasizing mindset. It's not that price action is flawed, don't get me wrong, it's just incomplete for most people. By becoming better at reading the Market Trinity, volume, value, and volatility, and incorporating it into your price action approach, you can dramatically improve your strike rate. You'll start to see the market not just for what it's doing, but why it's doing it. That kind of clarity takes the guesswork out of trading and gives you an edge most traders never develop. But here's where it gets even more critical. During major market disruptions, like black swan events, elections, or even unexpected news, many traders find their strategies completely break down. They enter massive drawdown phases, panic, and start strategy hopping. Now, while these strategies attempt to explain the mechanics of price movement, they still fall short of addressing the underlying why. Why does price move? Why do trends reverse? The answer lies within volume, value, and volatility. By focusing on these core forces, you gain the ability to adapt and stay consistent, even during unpredictable market conditions. No matter what's happening, pandemics, elections, or economic crises, the Market Trinity gives you the framework to understand and navigate the madness. And this brings us to the next critical step, the 7 key metrics that will help you read and master Market Trinity. But before we dive into those metrics, let's take a moment to go back to the origins of what many traders know today as smart money concepts. Let's take a step back in time to the early 20th century. A man named Richard Wyckoff was observing the markets, not just the tick-by-tick movement, but the psychology behind it. Wyckoff wasn't just a trader, he was a market philosopher. He believed that the market was like a living organism, driven by the actions and intentions of big players he called the composite operator. In his own words, quote, "The market is made by the minds of men, and it moves according to their hopes and fears," end quote. Wyckoff's approach was about understanding the story behind the price, reading the footprints of institutions during accumulation and distribution phases, and knowing when they were about to drive the market higher or lower. He laid out schematics and principles that taught traders how to think like these operators, not just react to the market. Fast forward to the late 20th century, and we meet Tom Williams, a former institutional trader who took Wyckoff's foundation and refined it. Williams developed volume spread analysis, VSA, a methodology that dives deep into the relationship between price spread, volume, and closing price. He believed, as he wrote in Master the Markets, that, quote, "volume is the key to unlocking the truth behind price movements," end quote. If Wyckoff gave us the blueprint to understand market phases, then Williams gave us the microscope to analyze what's happening inside those phases. Now, here's what's fascinating. Whether they realized it or not, both Wyckoff and Williams were describing the same core principles, the Market Trinity, or the 3 V's of trading. Wyckoff's work focused heavily on value, the mind of the market, and volatility, the body, while Williams zoomed in on volume, the soul. But while their philosophies align, their approaches differ. Wyckoff was more about the big picture, the story of market cycles, phases, and manipulations by institutions. Williams and VSA are about the fine details, pinpointing signs of strength and weakness in individual price bars. Despite these differences, they're literally 2 sides of the same coin. By merging them together, we can gain a powerful framework to understand the market from both a contextual level and a granular level, a 360-degree view of market dynamics. Now, here's where many traders stumble. When they try to implement Wyckoff's principles, and I'm guilty of this, they often get caught up in phases A and B of his schematics. These phases, which involve the buildup of accumulation or distribution, can take so many forms that they're hard to identify consistently. And because of that, traders either overcomplicate their analysis or miss the real opportunities. But here's the thing. The real magic happens in phases C and D, the points where the market makes its intentions clear. Phase C is where you'll see traps being set, the famous spring or upthrust that shakes out weak hands. Phase D is where the markup or markdown begins, the moment institutions tip their hand. Now, some of you might be wondering, why not focus on phases A and B? Isn't that where the accumulation or distribution begins? And yes, that's technically correct. But here's the reality. Phases A and B are incredibly nuanced and subjective. These early stages are where institutions are stealthy, often using complex tactics to disguise their intentions. Because of this, what looks like accumulation one day could suddenly flip into distribution the next. Phases C and D, on the other hand, are where the market's true intentions are revealed. Phase C is when you see the famous Wyckoff traps, the spring or upthrust, designed to shake out weak hands. These are pivotal moments that signal the transition into a new trend. Phase D is when the big moves, the markup or markdown, begin. By focusing on phases C and D, we cut through the noise and focus on the most actionable moments in the market. These phases give you clarity and conviction because the institutions are no longer hiding, they're showing their hand. But here's the key: spotting these phases isn't always straightforward. That's where volume spread analysis and modern order flow tools come into play. By layering the granular insights of VSA over the contextual framework of Wyckoff, we're able to decode these phases with greater precision and confidence. And if you're thinking, but what if I want to trade in phases A and B? Don't worry. Once you understand the Market Trinity, you'll start recognizing how shifts in volume, value, and volatility can guide you through those earlier phases too. Since volume, the soul of the market, is the genesis of both the market and the Market Trinity itself, we need tools that allow us to decode its story. This is where order flow tools come into play. At their core, these tools are derived from volume, real orders placed in the market. With these tools, we'll tie Wyckoff's contextual framework to VSA's granular analysis, giving us the ability to understand the Market Trinity: volume, value, and volatility in real time. These metrics are going to help you spot the moves before they happen, time your entries with confidence, and most importantly, stay one step ahead of the composite operator. But first, let's address an important misconception. There's a common belief among retail traders that because the Forex market is decentralized, volume data is unreliable or even irrelevant. But this couldn't be further from the truth. While it's true that the Forex spot market lacks centralized volume reporting, there's an alternative that the professionals rely on: data from the futures market. Why does this matter? Let's talk about the institutions, the big banks like Barclays, Deutsche Bank, and JP Morgan. These institutions account for over 60% of the total volume traded in the Forex market. And here's the secret: they use futures market data to track and manage this massive activity. Why? Because futures give them a clear and standardized representation of what's happening across the currency markets. Now, think about this. The reason retail traders are often called uninformed traders is because they lack access to or ignore this type of data. On the flip side, institutions are considered the smart money because they utilize tools like these alongside other data and resources that retail traders typically don't have access to. They're not just trading based on price action or arbitrary levels. They're informed by a deeper understanding of market dynamics derived from volume, value, and volatility. By not incorporating futures-based volume data into their analysis, many retail traders are essentially flying blind, while institutions are laser-focused, using all the information at their disposal. And here's the best part: this approach isn't limited to Forex or futures. It applies to all tradable markets, from stocks and indices to commodities and even cryptocurrencies. So, to help you get started, I'll be using an order flow charting platform in this video to break down the 7 key metrics and how that can transform the way you trade. I've linked it in the description box below, so you could check it out for yourself. Now that we've cleared that up, let's move on to introducing the first of the 7 key metrics. Let's start by talking about value, not just in trading, but across industries. In the business world, companies are measured by their intrinsic value. In real estate, properties are bought and sold based on perceived value. And in the markets, the concept of value is no less crucial. Warren Buffett said it best, quote, "Price is what you pay, value is what you get," end quote. Now, here's the problem. Traders spend so much time comparing current price to previous price, but professionals, the smart money, are focused on a different question. Where is the market building value? This focus on value is a cornerstone of institutional trading. Unlike retail traders who rely on static concepts like support and resistance, institutional traders treat these zones as dynamic value areas shaped by the flow of real orders. For example, hedge funds or banks don't just look at price action in isolation. They analyze whether the market is building value higher, lower, or sideways. One of the key tools they use to do this is volume profile. What is volume profile? Volume profile is a visual representation of the market's activity at each price level, derived from the depth of market data. It shows where the most trading has occurred, creating 3 important components. The value area high, the upper boundary of where 70% of the volume is concentrated. The value area low, the lower boundary of that 70% range. And the point of control, the price level with the highest traded volume, often representing the fairest price for buyers and sellers. By focusing on these areas, we can identify whether the market is establishing value higher, lower, or sideways, providing critical insights into market behavior. And here's the best part. Unlike the subjective nature of support and resistance, volume profile gives us an objective and factual approach to analyzing the market. This is why institutions rely on volume profile, because it's rooted in real data and reflects where smart money is most active. For example, Barclays or Deutsche Bank, which are responsible for billions of dollars in daily Forex trades, analyze these zones of value to determine their points of interest. By doing so, they gain a competitive edge. Compare that to retail traders, who often focus solely on price patterns or arbitrary levels that lack consistency. This disparity is why institutional traders dominate. They're not just reacting to price, they're proactively identifying areas of interest where value is shifting. So, since we're implementing a Wyckoff and VSA approach, it's only logical to start by identifying areas where smart money seeks value. Wyckoff emphasized the importance of accumulation and distribution zones, while VSA focuses on the volume dynamics that happen at these critical levels. The value area high, the value area low, and the point of control are perfect tools for pinpointing these zones because they reveal the areas where institutions are most likely to get involved. While volume profile has many advanced topics, such as poor highs and lows, single prints, delta nodes, and volume profile shapes, we'll keep it simple because the most critical takeaway is this: the value area high, low, and point of control are the best areas to apply Wyckoff and VSA principles. When price is accumulating or distributing near these levels, we can anticipate the markup or markdown phases, which represent smart money's true intent. These phases provide opportunities for us to align our trades with institutional activity. However, when price reaches these areas, it's equally important to monitor volume dynamics to confirm smart money's interest. This is where volume profile and VSA work together. When volume confirms institutional activity at these levels, it sets the stage for powerful, high probability setups. And that brings us to our next key metric, climactic action. Imagine a wildfire spreading rapidly across a dry forest, consuming everything in its path. The flames rage uncontrollably until a team of firefighters arrives with water hoses and barriers to stop the fire. At first, the firefighters don't put out the fire completely. They focus on slowing it down by dousing the flames and containing its spread. As they continue working, the fire weakens, eventually burning itself out. Once the fire is fully controlled, the firefighters create conditions for the forest to regrow, bringing life back to the area. This story is a metaphor for what is referred to as climactic action in the markets. Now, let's break it down. The wildfire represents a powerful market trend. Think aggressive buying or relentless selling, fueled by a frenzy of emotions, fear, greed, momentum chasers. The firefighters are the institutional players, the smart money, stepping in to absorb the pressure and stop the trend. The water and barriers represent the capital or volume orders and strategic actions used to slow the market's momentum. The containment. This reflects the consolidation phase where the trend begins to lose strength. And the regrowth represents the reversal where the market moves in the opposite direction after the trend has been extinguished. Now, in trading terms, climactic action is when the market experiences unusually high volume during an extreme price move, signaling that smart money is stepping in. It's the firefighting phase, where the trend starts to weaken because professionals find value at that price level and absorb the aggressive market activity. So, with volume spread analysis, you can detect climactic action by identifying unusually high volume followed by a sharp price move. This shows that professional traders are stepping in to absorb the activity from retail traders or even other institutions. Here's what to look for. The candle range or size is typically wide with a surge in volume that indicates heavy participation from larger players. The key? Absorption. In a downtrend, this is the absorption of supply. In an uptrend, it's the absorption of demand. Basically, the primary purpose of climactic action is to halt the current trend, whether up or down, and prepare the market for its next major move. Climactic action plays a critical role in Phase A or Phase B of the Wyckoff accumulation or distribution schematic. But here's the thing, we're not here to spend hours drawing schematics and trying to perfectly mark them out. Why? Because ranging phases can take time, a lot of time. In his book, Trading in the Shadow of the Smart Money, Gavin Holmes, mentored by VSA pioneer Tom Williams, explains that institutions must ensure their massive orders are satisfied. This explains why accumulation or distribution phases don't happen overnight. However, by identifying climactic action, we can start preparing for the next phase, a markup after accumulation and a markdown after distribution. This is where we wait for signs of strength during the markup phase or signs of weakness in a markdown phase. But we'll dive deeper into how to identify these in the coming metrics. Here's something crucial. Just because you spot climactic action doesn't mean you should jump in immediately, expecting a reversal. Many traders online discuss absorption during climactic action, but a common mistake is stepping in too early, assuming an immediate reversal will follow. While the intention to act quickly is understandable, this approach is risky because trends can often continue before the reversal happens. The thing is, absorption can appear in different forms. Just because you spot it doesn't mean it's time to take action right away. Context is everything. Without considering the broader picture, you risk getting in prematurely or misinterpreting the market's intentions. This ties back to why institutions don't always agree on value. One institution might perceive value at a certain price level and absorb aggressively, while another sees it differently, leading to conflict. This disagreement often results in what's called a bidding war, where heavy volume appears on both sides of the market. Imagine institutions battling it out, some aggressively buying while others are equally aggressive in selling. The result? A tug of war. And that brings us to the next key metric, two-way absorption. Let's start with an African proverb. When two elephants fight, it is the grass that suffers. It's a simple yet profound metaphor. When the biggest players in the market, institutions and professional traders, engage in their tug of war, it's often the retail traders who end up being trampled if they're caught in the middle. In trading, sometimes this is what happens during accumulation or distribution phases. As retail traders, our focus shouldn't be on diving into the chaos prematurely. Instead, we wait for confirmation, a clear sign of strength or sign of weakness before taking a position. Otherwise, we risk becoming collateral damage in a war we can't win. This brings us to an important point. Even the so-called smart money doesn't always get it right. Take these examples of institutional trading losses. 1995, Barings Bank lost $1.3 billion due to rogue trader Nick Leeson. 2008, Lehman Brothers collapsed with $600 billion in assets amid the financial crisis. 2012, JP Morgan Chase, the London whale trading scandal cost $6.2 billion. And in 2021, RK Gold's Capital Management lost over $20 billion, causing a ripple effect across major banks. These aren't minor errors, these are monumental mistakes that have even inspired movies like Margin Call. They're extreme examples, but they highlight one crucial point: the big players aren't infallible. So, who are they losing to? Not retail traders, at least not in most cases. Historically, long before retail traders even had access to markets, institutions were trading among themselves. Some won and others lost. This is beautifully captured in the 1985 BBC documentary $1 Billion Day, which shows how banks competed in the currency markets with winners and losers on both sides. So, what does this have to do with two-way absorption? In markets, two-way absorption occurs when both sides, buyers and sellers, battle within a range, neither gaining a decisive edge. For us as traders, the lesson is simple. Don't pick a side until one of the elephants has clearly won. Here's where the tools come in. To spot two-way absorption, we turn to Renko charts, volume and volume profile analysis. Renko charts filter out market noise, making it easier to spot ranges. Instead of traditional time-based candles, Renko focuses purely on price movement, giving a cleaner view of sideways action. Now, within a Renko identified range, the key is to analyze the volume profile of each candle. If the point of control appears near both the high and low of the range, it signals that both buying and selling participants are actively absorbing each other's positions. This high volume tug of war is a textbook sign of two-way absorption. Our entry cue comes when the range breaks, accompanied by a clear sign of strength or sign of weakness. There are a few key takeaways here. The first being, even institutions don't have a holy grail. Losses happen at every level, reinforcing the importance of good risk management. Secondly, context is everything. Absorption signals alone aren't enough to take a trade. We need confirmation of the trend direction to reduce our risk. Finally, let's redefine what smart money really means. It's not the side causing the range, it's the side that triggers the trend. And while institutions dominate this role, there are rare moments when retail traders step into the spotlight, like in the GameStop situation led by Roaring Kitty. This reminds us why we wait for clarity and align ourselves with the side that drives the market forward. And that brings us to our next key metric, liquidity drivers, where we'll look into who's really fueling the market moves.
Let's just have a look at it now. Watch this. Jason Gardner, who had the false start, remember, got off absolutely brilliantly. The World Indoor 200-meter champion hits down into the straight, transition good, and here goes Mark Lewis Francis again. He's got it, and he believes, look at that look, they can't catch me, they mustn't catch me, they daren't catch me. They almost did, but they didn't.
If you've ever seen a relay race, you'll know it's not just about the runners, it's also about the baton. Without the baton, there's no race. Liquidity and liquidity drivers work in a similar way. Liquidity is the baton being passed between market participants, the liquidity drivers, shaping price movements and ultimately deciding the direction of the market. Think back to the metrics we've covered so far: climactic action, two-way absorption. They both emphasize how institutions maneuver around liquidity. But here's the real question. Who's driving the market? In a downtrend, sellers dominate, searching for liquidity, buyers willing to take the other side of the trade. If these buyers overcome selling pressure, they become the takers of sell liquidity, flipping the script. Suddenly, sellers become liquidity givers, and the buyers start driving prices higher in search of new liquidity. The same dynamic applies in reverse during uptrends. This constant tug of war between givers and takers isn't just noise, it's the heartbeat of the market. And understanding it is critical for knowing when to join the winning side. In volume spread analysis, we're often taught to analyze the background, the cause and effect behind price movements. Is there strength lurking in the background, signaling a potential uptrend, or weakness foreshadowing a downtrend? We've already covered one way to spot this through climactic action, but here's another. Zooming in on the actual orders coming into the market at critical levels. Whether it's an accumulation or distribution range, liquidity drivers give us a direct view of who's in control. To uncover these drivers, we can use advanced order flow tools like Adaptive Big Trade and Cluster Search. Adaptive Big Trade helps identify large trades in real time, showing where institutions or other big players are entering the market. It highlights clusters of significant trades, offering a clear view of major activity at key levels. Cluster Search works hand in hand with this by analyzing volume and price at a granular level. It pinpoints specific areas where significant buy or sell orders are concentrated, helping us see where big players are building or exiting their positions. For example, if we spot heavy buy-side activity at a low during a range, it's likely an accumulation phase before a markup. Conversely, large sell-side activity at a high often signals distribution before a markdown. These tools give us concrete evidence of who's taking liquidity and who's giving it, adding weight to our directional bias. Once the accumulation or distribution phase is over, we look for signs of strength or signs of weakness to confirm the trend. This is another place where liquidity drivers come into play because they help us align with the winning side just as the markup or markdown phase begins. By waiting for these signals, we can enter trades with confidence, knowing the odds are stacked in our favor. So, this naturally leads us to our next key metric, trend pulse. Once we've identified who's in control, the next step is to measure the rhythm of their activity. Are they accelerating or slowing down? Is the trend gaining momentum or losing steam? With liquidity drivers showing us who's behind the moves and trend pulse revealing the intensity of those moves, we build a complete picture of the market's behavior, one metric at a time. Before we dive into this next section, let's take a step back and reflect on what we've covered so far. We've learned how to spot the participation of smart money at value areas by identifying accumulation and distribution ranges using Wyckoff principles and the clues left behind by liquidity drivers. Now, it's time to go one step further. The question we need to ask is this: how do we confirm a change in market behavior to support our directional bias? One way to do this is by looking for a trend pulse, the heartbeat of the market that tells us when we're transitioning out of an accumulation or distribution phase and into a markup or markdown phase. Now, there are countless tools traders use for this: market structure, trend lines, and moving averages, to name a few. But for us, the VWAP is king. Why? Because it fits seamlessly into our Market Trinity approach, combining the insights of volume, value, and volatility. VWAP, volume weighted average price, is an incredibly versatile tool. It gives us a weighted average of price based on volume and is often used as dynamic support or resistance. But here's the thing: most traders focus solely on the VWAP line itself and ignore its deviation bands. These bands, calculated as standard deviations of price from the VWAP, can reveal critical insights into the rhythm or pulse of a trend. When price moves in relation to these bands, it reflects not just the direction of the trend, but also its strength, momentum, and the balance of power between buyers and sellers. And here's where it gets even better. When paired with Wyckoff's principles, VWAP helps us identify signs of strength or signs of weakness. Wyckoff explained that these signs often manifest in the form of widening price spreads, increased volatility, and shallow retracements. With VWAP, we can visually confirm these changes in behavior. A strong trend often sees price bouncing off the deviation bands, signaling that demand is overpowering supply, or vice versa. Conversely, weak trends will see price struggle to hold the bands, reflecting a lack of conviction. So, why does this matter? Because understanding the trend pulse gives us insight into the behavior of the big players, the liquidity takers, and the aggressiveness of the orders driving the trend. For example, in a strong trend, retracements tend to be shallow, as liquidity takers don't want to risk missing the move. Passive orders have less time to fill, forcing participants to become more aggressive. This same logic applies to us as traders. If we wait too long for a perfect pullback, like a Fibonacci retracement, the trend may be long gone. By understanding the rhythm of the market through VWAP and its bands, we can spot opportunities earlier, entering during the sign of strength or sign of weakness phases after an accumulation or distribution. For instance, if price consistently bounces off the upper or lower deviation bands, it suggests strong conviction from liquidity takers. On the other hand, if price starts to struggle around the midline of the VWAP, it could signal a loss of momentum or a potential reversal. This metric ties directly into the next one: imbalance. When we see stacked imbalances, it's another way of identifying signs of strength and signs of weakness. Why? Because these imbalances represent aggressive participants stepping in to overpower the other side. So, understanding the trend pulse is not just about spotting the trend. It's about getting into sync with the market's flow, recognizing the aggressive nature of liquidity takers, and positioning ourselves to capitalize on their moves. Now, let's move on to the sixth metric, imbalance, where we'll take a closer look at how to spot aggressive participants driving the market. Let's talk about something that most traders overlook, but is critical for understanding what's really happening under the surface of the market. Imbalance. Picture this: two sides of a tug-of-war game. One team has 10 players pulling it hardest, while the other team has just 2 players giving it everything they've got. You don't need a crystal ball to predict the outcome. It's clear that the team with the numbers and the force will win. In trading, the market operates on a similar principle. Buy and sell orders interact in a constant tug of war. Imbalance occurs when one side of this struggle clearly dominates the other. And guess what? By identifying these moments, you can trade on the side of the stronger team, the side that's about to drive the market in their favor. Imbalance is a key concept in volume analysis. It refers to a disproportionate number of buy or sell orders at a given price level. Essentially, it's when buyers or sellers overwhelm the other side so decisively that it leaves a visible footprint in the market. Think of it as the battle scars left on the order book. And just like a seasoned warrior studies the scars on their shield, we study imbalances to uncover hidden truths about who's winning the fight. Now, let's break it down. When you look at an order flow chart, specifically the footprint or cluster charts, you'll notice numbers showing the volume of trades executed at different prices. This is where the magic happens. A buy imbalance occurs when there are significantly more aggressive buyers than sellers at a price level. A sell imbalance is the opposite. Aggressive sellers overwhelm buyers. For example, if buyers aggressively hit the ask price with 500 lots while sellers only manage 100 lots, that's a buy imbalance. Now, why does this matter? Because these imbalances reveal the market's superior forces. They show where liquidity is being consumed and where it's about to drive price action. Here's where things get interesting. Imbalances aren't random. They're the footprints of smart money and large players positioning themselves. Wyckoff and VSA teach us to look for signs of strength or signs of weakness. Imbalances often occur during these moments. Stacked buy imbalances appear in markup phases, signaling demand outstripping supply. And stacked sell imbalances show up in markdowns, where supply overwhelms demand. These clusters of imbalances act as validation points, telling us we're on the right side of the trend. This is why imbalance works so well with the metrics we've covered so far. In two-way absorption, imbalances can signal the point where one side finally breaks. With Trend Pulse, we observe how imbalances align with the VWAP deviation bands, showing when trends gather momentum. And with liquidity drivers, imbalances give us a glimpse of the force behind liquidity takers and givers. When combined, these metrics give us a complete view of market dynamics. So how do we use imbalances in real trading? The key is to focus on areas of interest, value areas, accumulation or distribution zones, and wait for imbalances to confirm the next move. For example, during a range, imbalances near the highs or lows can signal a breakout. In a developing trend, stacked imbalances confirm momentum and allow you to ride the wave with confidence. This also helps us avoid the trap of preempting moves. Instead of guessing, we're reacting to real-time evidence of strength or weakness. Finally, this brings us to the last metric, exhaustion. While imbalances show the winning team, exhaustion signals when the winners might be running out of steam. It's the final puzzle piece in understanding how trends evolve and reverse, tying back to everything we've discussed so far. We've reached the final piece of our 7 key metrics puzzle, and this one is all about knowing when the market is running on fumes. Picture a runner pushing themselves to their limit, sprinting faster and faster. But just as they're about to cross the finish line, they stumble, gasping for air, completely spent. That stumble? That's exhaustion. But before we go into the mechanics of exhaustion, let's clear up a potential source of confusion. Exhaustion, as we're discussing it here, is not the same as climactic action, which we explored earlier. Climactic action often leads to a period of accumulation or distribution before a reversal takes place. Exhaustion, on the other hand, typically results in an instant reversal, a sharp, decisive turning point in the market. Now, let's look into this principle in more detail. In trading, exhaustion is where the market's trend starts to fall apart, its last gasp before reversing. And when it comes to identifying exhaustion, two of the most powerful patterns you'll encounter are the shakeout and the upthrust. The shakeout occurs in a downtrend. Picture the market taking one final nosedive to scare off weak hands and grab liquidity. Smart money uses this move to scoop up cheap assets before driving prices higher. Now, upthrust is the inverse of the shakeout. In an uptrend, the market spikes aggressively higher, luring in buyers at elevated prices before smart money dumps their holdings and sends the market tumbling. Both patterns act as traps. Retail traders fall for the bait, whether it's a breakout to the downside or upside, only to find themselves on the wrong side of the move. These traps mark the exhaustion of aggressive buying or selling, signaling a major shift in market direction. Volume spread analysis gives us the tools to spot these exhaustion points. Both shakeouts and upthrusts tend to occur on high volume and large spreads, wide range bars. But here's the kicker: the effort doesn't match the result. For example, a shakeout might show a massive red candle with huge volume, but the price barely closes below its low or reverses soon after. This indicates absorption. Smart money is buying into the sell-off. An upthrust might have an explosive green candle on high volume, but the price struggles to hold its gains and closes near its low. This signals smart money is selling into the rally. The market looks strong on the surface, but under the hood, smart money is setting the stage for the next major move, usually in the opposite direction. Here's where we level up. While traditional candlesticks can help you spot shakeouts and upthrusts, Renko charts give you a cleaner, noise-free view of the market. With Renko, you're not distracted by every tick. Only the meaningful moves stand out. Now, pair this with the cluster statistics indicator and you start seeing a whole new level of precision. Look at the delta, the difference between buying and selling activity at the tails of Renko candles. A strong delta at the bottom of a shakeout or the top of an upthrust tells you who dominated that move, buyers or sellers. Using the min delta and max delta, you can pinpoint whether aggressive orders are concentrated at the extremes of the candle. This confirms whether smart money is stepping in to absorb the trend's final push. By combining Renko charts and cluster statistics, you can spot these exhaustion points with laser accuracy. It's like having X-ray vision into the market's inner workings. These exhaustion patterns often align with critical moments in the Wyckoff framework. Shakeouts typically occur in phase C of accumulation, while upthrusts appear in phase C of distribution. In both cases, they mark the final showdown between smart money and the rest of the market before the trend shifts into markup or markdown. However, in some cases, you can find them in phase D at the last point of support during a markup or at the last point of supply in a markdown. Here's the bottom line: shakeouts and upthrust are more than just patterns. They're signposts of smart money's activity. When you identify these moments of exhaustion, you're not just guessing, you're aligning yourself with the market's most powerful players. And when you combine this knowledge with the other metrics we've covered, you gain an edge that most traders don't have. Exhaustion is the grand finale of our key metrics because it captures everything we've discussed so far. Volume, the heartbeat of the market, showing where smart money is most active. Value, the mind of the market, revealing where smart money sees opportunity. And volatility, the body and range of the market, expressing its energy and movement. By understanding exhaustion, whether through shakeouts, upthrusts, or advanced tools like Renko and cluster statistics, you position yourself to catch the market's biggest moves before they happen. And with that, let's have a look at some real-world examples of these principles in action on the charts. So, you now understand the Market Trinity: volume, value, and volatility, and how they come together through the 7 key metrics. It's time to bring it all together. In this section, we're going to walk through real market examples so you can see exactly how these concepts show up in the charts, how context builds, how shifts in value lead to opportunity, and how volatility acts as the final trigger. This is where it all clicks, because theory is one thing, but seeing it play out in real time is what builds confidence and turns knowledge into skill. So let's get into the case studies. This trade here is a masterclass in understanding how smart money functions and why we should aim to align with their intentions to improve our edge. It's also a perfect showcase of how the Market Trinity and 7 key metrics work together. Pre-London session, GBPUSD was trending up, bouncing perfectly off the upper VWAP standard deviation band, a dynamic area we know acts as a key zone for value in the trend pulse metric. But then, price slips below the upper band and heads toward VWAP, where it consolidates. This was the first signal of a weakening trend pulse. But here's where most traders go wrong. When London opens, we get a strong bullish candle. Buyers pile in looking for the trend continuation. But what they didn't see was smart money already positioning themselves for the big move. This bullish move was pure manipulation. Smart money wasn't joining the ride, because those early buyers' exit positions would later be used as liquidity by smart money who have the intentions of getting in cheap at lower prices. After the bullish trap, price consolidates at the upper VWAP standard deviation band. What was once support is now resistance. Then, price pushes below VWAP and attempts to recover, but fails. Here's where the cluster search indicator brings the story into focus. On the candle that started the flush, we see massive stacked sell imbalances, the day's highest volume, and a shocking sell delta of 1431. Compare that to the average delta of around 100 or minus 100, and it's clear this isn't a regular move in the market. And to add to that, there were no news to justify this. It's pure smart money manipulation. The next candle is where everything clicks. It's a larger bearish candle with even higher volume. But, and this is critical, it closes near the middle instead of its lows. This is textbook VSA climactic action. Think about it. If smart money were genuinely selling, wouldn't the candle close at its low? Instead, they're absorbing up all the selling pressure, positioning themselves for massive buys. The cluster statistics indicator makes it undeniable. Look at the delta. Bullish. Sellers are being absorbed, and smart money is stepping in. See, price had been consolidating for weeks, finding value around this area, and the point of control at 1.2647 served as a magnet for institutional buying, and the selling climax confirmed it. This is what caused the sideways movement, which was the accumulation phase before the reversal started. Once the accumulation phase ended, the market starts showing its hand. The first sign of strength. Price breaks above VWAP and clears the initial selling candle. Then a retracement back to VWAP, which was once resistance, is now flipped and becomes the last point of support. At the second test of VWAP, stacked buying imbalances show up. indicating that buyers are getting aggressive. This was the second sign of strength. For the third sign of strength, price tests VWAP one more time at the same area where buyers got aggressive. Then, during the ISM Services PMI news, a large bullish candle breaks through the inverse head and shoulders neckline, perfectly aligned with the upper VWAP standard deviation resistance. The breakout led to price trading higher, confirming the start of the markup phase. If you're tuned into Market Trinity, these signs are glaringly obvious. Volume confirms the aggression, value aligns with institutional levels, and volatility breaks the stagnation. Fast forward to December 6th, the uptrend stalls and smart money begins their exit. A large bullish candle appears with ultra high volume, closing near its high. Traders might see this as bullish continuation, but the delta metric reveals a negative delta. This is climactic action. Smart money isn't buying, they're selling. After this, price drifts upwards slightly on declining volume, signaling the start of the distribution phase. Then comes the Upthrust, a bearish pin bar with significant buying delta concentrated in the tail. Turn on the cluster search indicator and it highlights aggressive buying orders trapped at the highs. Price immediately reverses and a bearish engulfing on the next candle confirms the shift with the biggest sell delta since the distribution phase. Sellers are now taking liquidity from buyers. For those familiar with ICT concepts, you might notice this bearish candle formed a fair value gap, but by applying the principles we've already covered, you gain a much deeper understanding of what's really happening here. Take the earlier bullish climactic candle as an example. It also created a seemingly convincing fair value gap. However, if you tried to buy on the retest, it would have failed, as price sliced straight through it. Why? Because fair value gaps are only as good as the intent behind them. And here, the intent was distribution, not continuation. The final nail in the coffin comes with a no demand bar, a bullish candle with bearish delta. Sellers were absorbing buyers' volume to prepare for the next leg down. And when the confirmation candle hits, the sell-off began, marking the largest bearish leg since the markup phase. This trade is a crash course on why the Market Trinity and the 7 key metrics are so powerful. By understanding volume, value, and volatility, we could understand major moves. The false trend continuation, pure manipulation, spotted by trend pulse and VWAP dynamics. The accumulation phase, clear as day through climactic action, delta, and imbalance metrics. The distribution phase, the liquidity drivers, and exhaustion metric exposed the exit strategy. And what about the traditional ICT concepts like fair value gaps? They're great, but without the deeper understanding the Market Trinity provides, you're still trading blind. This trade wasn't just about entries and exits. It was about knowing why smart money did what they did and aligning ourselves with them. This is what separates the 10% who win from the 90% who lose. Now, let's take a look at another example to keep sharpening that edge. On this day, gold starts in a state of equilibrium before the London session, with price respecting the second VWAP standard deviation bands on both ends. This balance between buyers and sellers created a neutral environment, giving us little to work with initially. But then London opens and everything starts to shift. The first major clue, volatility begins to shrink. Instead of price moving between the outer edges of the second VWAP deviation bands, we see it tighten up, oscillating within the first bands. This contraction of volatility hinted at a potential buildup. And as we know, shrinking volatility often precedes an expansionary move. Here's where things get interesting. Price makes a weak push lower, stalling just below VWAP before reversing and moving higher. But even that move higher shows hesitation. It fails to reach the high of the day or the second upper VWAP band, rolling over and heading lower instead. Now comes the false sell-off. As price takes out the London session low, it tempts traders to go short, thinking the break signals continuation. But here's the thing, volatility had already shrunk. We knew to expect price to react at the first lower VWAP band, not the extremes of the second. The biggest giveaway though, the aggressive selling orders that poured in as the session low was breached. Let's break this down. The sell candle that took out the session low didn't seem climactic at first glance. It wasn't unusually large, but when we analyze it with more precision, the signs of exhaustion become clear. Stacked selling imbalances appeared, showing aggressive selling. On the 10-tick Renko chart, the selling volume concentration was off the charts, with a delta to volume ratio of 100% selling and no buying. Turning on the adaptive big trade indicator, we spot a massive sell order of 225 lots, one of the largest trade sizes in the last 5 days. This was classic climactic action, although very subtle on the surface. Now, if this sell-off represented smart money dumping positions, price should have continued to collapse, but it didn't. Instead, the next candle tells the real story. Ultra high buying volume steps in. This wasn't random retail activity. This was demand overpowering supply. The buyers weren't waiting for better prices. They were stepping in aggressively, becoming liquidity takers. But smart money doesn't stop there. They mark the price down once more to retest the low, looking to flush out any remaining sellers. This time, the volume on the test is nearly non-existent. A clear no supply signal. No sellers remain. And just like that, the reversal begins. After the low volume test of the lows, price forms a double bottom, and on the break of the neckline, stacked buy imbalances appear. Clear evidence of aggressive buyers stepping in, which was the first sign of strength after accumulation. Then, price pushes higher, breaking the high of the day and surging to the second upper VWAP deviation band, after which momentum slows and price consolidates sideways for the remainder of the session. This trade perfectly showcases the principles of the Market Trinity and the 7 key metrics working in harmony. From the shrinking volatility signaling a potential reversal to the climactic action flushing out sellers, every piece of the puzzle aligns. Notice how we use tools like the VWAP bands to gauge volatility and trend pulse, combined with insights from order flow analysis, such as stacked imbalances and Renko charts to confirm smart money's intentions. Without these metrics, we might have been fooled by the false sell-off or missed the low volume test of the lows. By aligning ourselves with the Market Trinity and deciphering smart money's blueprint, we position ourselves to trade with confidence, and with the buyers dominating, the path higher became clear. Now imagine applying these principles across different markets and timeframes. With this level of clarity, you're not just guessing where price might go, you're understanding why it's moving. This trade on S&P 500 summarizes the power of combining trend pulse, volume analysis, and simple yet effective technical patterns like trendline breaks. Let's break it down. The day begins with bearish sentiment dominating the market. VWAP is acting as a dynamic ceiling, rejecting price every time the day's lows are breached. This tells us sellers are in control, consistently defending higher prices. Post US market open, price attempts to rally, testing the trend line drawn from the previous day's low. On its third touch, price shows signs of life, trading higher but ultimately stalling as it nears VWAP, which is still behaving as resistance. Here's where things get interesting. Price makes one final push higher, but this attempt fizzles. Switching to the 10-tick Renko chart, we spot the real story. Selling delta starts to flood in, showing clear signs of bearish aggression. This selling pressure drives price to break below the trend line, a critical moment. After breaking, price retraces slightly but rejects off the lower VWAP band, which now flips from support to resistance. This rejection shifts the pace of the trend, showing us that the bears are becoming even more aggressive. This change in pace signals a transition. The trend is no longer merely bearish, it's accelerating. If we had any doubts, they were erased by what happened next. A massive selling delta of -64.53, a standout figure even for this high volume market. On the 3-minute candlestick chart, this was followed by a selling climax, a surge of ultra high volume signaling capitulation. At first glance, this might seem like the end of the downtrend, but here's the lesson: never preempt a reversal after a selling climax. Wait for signs of strength post-accumulation. Following the selling climax, price stalls momentarily, hinting at a potential reversal. But rather than breaking higher, the lower VWAP band, now firmly acting as resistance, rejects price yet again. This rejection aligns with that massive selling delta of -64.53, reaffirming the strength of the bearish trend. Price then resumes its decline, breaking below the selling climax candle's low, a critical confirmation that sellers remain firmly in control. One final retest occurs as price climbs back toward the highest sell delta of the selling climax candle bar. This retest aligned perfectly with the lower VWAP band, which once again holds as resistance. Sellers step in aggressively, driving price lower to close the day on a bearish note. Here are the key takeaways. Trend pulse matters. The shift from VWAP as resistance to the lower VWAP band acting as resistance indicated a change in the trend speed and aggressiveness. Recognizing this subtle shift was crucial in staying aligned with the bearish trend. The second takeaway is volume confirms intentions. The massive selling delta of -64.53 and the subsequent selling climax showed us where the real activity was happening. Without volume and delta analysis, this trade might have seemed like a potential reversal, but the metrics painted a clear bearish picture. And lastly, patience over assumption. Selling climaxes often signal an approaching reversal, but this trade reinforced the importance of waiting for confirmation. No signs of strength appeared post-accumulation, making the continuation of the bearish trend the logical outcome. This trade beautifully illustrates how the Market Trinity and the 7 key metrics elevate a trader's edge. We saw value in VWAP dynamics, volume through climactic action and selling delta, and volatility through the trendline break and VWAP band rejections, all working in harmony to reveal the true intentions of market participants. By understanding these principles, you're not just reacting to the market, you're anticipating its next move, positioning yourself alongside the smart money and staying out of traps like premature reversals. This is the power of aligning with the Market Trinity and mastering the 7 metrics. It turns an ordinary trendline break into an extraordinary trading opportunity. This trade is another textbook case of why you never preempt a selling climax and how two-way absorption reveals a battle of opposing forces. As we mentioned earlier, this is the market equivalent of 2 elephants colliding. Their struggle creates opportunity. The day started off balanced, with neither buyers nor sellers taking the lead. But when the US session opened, we saw an aggressive push to the downside, culminating in a widespread climactic bearish candle. Then, the market stalled and started moving sideways. Now, here's where things get interesting. When we flipped to the 10-tick Renko chart, the consolidation revealed its true nature. This wasn't your everyday sideways chop. First, the volume on most of the Renko candles was significantly above average. Second, the points of control sat at the extremes of the range, showing buyers and sellers being absorbed at both ends. When price finally broke to the downside, the adaptive big trade indicator lit up, showing the largest lot size order of the day, 1,057 lots. On top of that, the delta for this candle was the most bearish of the session at minus 1753. Zooming in, you could see multiple sell imbalances and a stacked imbalance within the candle, a definitive sign of weakness. Following this breakout, price continued to sell off, but the buyers weren't giving up without a fight. After the sell-off, we saw a selling climax on the 3-minute chart. This was the largest volume candle of the day, but the close was closer to the middle of the candle rather than the low, a classic sign of absorption. The cluster search indicator confirmed this, detecting buying volume concentrated at the tail of the candle. Even more telling, the candle delta flipped bullish at plus 1802. As the last remaining sellers were absorbed, price drifted slightly lower before reversing, breaking above the selling climax candle. On the retrace, the market tested the selling climax and put in a last point of support at the lower VWAP band. Here, aggressive buyers stepped in again, confirmed by a bullish stacked imbalance, signaling a sign of strength. Price pushed higher, breaking above VWAP, signaling that bearish momentum was fading fast. Now, let's pause here. Two critical things happened at VWAP. Firstly, this was the same area where we saw the two-way absorption earlier, buyers and sellers battling it out. And secondly, for harmonic pattern traders, this area aligned perfectly with a bearish Gartley pattern. If you had the context of the two-way absorption earlier, you'd know that buyers got absorbed and are likely to exit their positions by selling here. Combine that with the bearish Gartley and VWAP acting as resistance, and you've got a strong case for a sell. And sure enough, price dipped back down. But here's the twist. Price action had already shifted after the selling climax, and strength was evident in the background. When price traded lower, it stalled exactly where the earlier sign of strength from the stacked buying imbalance had occurred. The buyers defended their positions, preventing any further downside. After a brief period of consolidation, the market resumed its upward trajectory. This example reinforces the importance of patience, context, and alignment with the Market Trinity and 7 key metrics. The interplay between volume, value, and volatility here was crystal clear, and understanding how these forces interact allowed us to stay a step ahead of the market. I know what you're thinking. Sure, these principles work on lower timeframes, but can they stand the test of higher timeframe analysis? This example answers that question with one of the most impressive calls I've ever made, proving that these concepts don't just work, they're timeless. Back in August 2022, I posted a video on YouTube predicting silver would climb to the mid $30 range after hitting my expected price of $17.50. This right here is a VSA shakeout, and what this is doing is grabbing liquidity for all the early buyers. And then what did we see? We saw that price went ahead and took off drastically to the upside. Obviously, this was during the whole pandemic, and I'll probably do a separate video going a little more in depth on this pair, basically, because there's a lot going on here, especially VSA wise, with the volume of what was happening here and how I know that this will eventually go to the upside. So as you can see already from my markup, and predicting that price should continue to the upside. 2 years later, not only did silver reach those levels, but it also set a 12-year high of $35. That's a 100% gain from my entry and a solid 75% from when I published that prediction. Let me prove it. If I search my computer for a folder titled The Great Silver Accumulation, you'll see it was last modified on December 22nd, 2020. Inside that folder are charts I published on TradingView as far back as July 2020. The first chart shows where I began tracking silver, right after a climactic shakeout candle reversed the price trend. Weeks later, as silver hit $30, I anticipated a retracement to the highest buying volume level between $17 and $16.62. Something I annotated clearly at the time. Fast forward 2 years and silver lands at $17.55, just 4 cents shy of my projection, forming a bullish harmonic Gartley pattern. This coincided with the release of my YouTube video, and the rest, as they say, was history. Now, let's break it down. If you've paid attention to everything we've covered so far, this trade should make perfect sense. Right at the pandemic start in March 2020, silver saw a massive sell-off on climactic volume, dipping below a double bottom. Early buyers and weak holders were shaken out, and this was where smart money made their move, scooping up positions at dirt cheap prices. From there, the market broke above a long-term downtrend that had been in play since 2012, signaling that smart money had clear intentions to drive prices higher. Silver retraced to the high of the climactic shakeout candle, landing at $17.55, which became the last point of support before a parabolic rally to its 12-year high of $35. This wasn't just a trade for me, it was an investment. I've been accumulating physical silver for years, and this analysis was a key factor in my decision to build and top up my positions. This final example ties everything together, from recognizing climactic action and shakeouts to spotting smart money accumulation, to understanding how markets signal a true change of behavior. This is the blueprint for success, whether you're day trading or investing. We've dissected examples across different timeframes and instruments, proving that the principles of volume, value, and volatility, the Market Trinity, and the 7 key metrics aren't just theory. They are a practical edge. Now that you've seen how these principles play out in both intraday and longer term context, let me leave you with this. Don't change anything you're doing right now. Seriously, keep doing what's working for you. But the next time you take a loss, or even when you bag a win, go back and look at everything we've covered here. Ask yourself, was there something from these principles I could have applied? Maybe something that would have turned a loser into a break-even, or even a winner. Over time, you come to realize what I did. There's no secret sauce, no magic strategy waiting to unlock consistent profitability. Every strategy you can imagine has an edge, but the traders who consistently come out on top, they're the ones who learn to amplify that edge by truly understanding the Market Trinity and the principles governing it. Becoming a profitable trader isn't about hacks or shortcuts. It's about mastering the basics, using the right tools, and developing the discipline to execute them with precision. The market isn't out to get you, but it will expose you if you don't take the time to understand it. And every time you press the buy or sell button, just remember, you're stepping into a game with players who have far deeper pockets and far more resources than you. To beat them, you need to think like them. If there's one thing I want you to walk away with, it's that context is the edge. You can master all the technical tools in the world, but if you're not tuned into the bigger picture, you will always feel a step behind. The traders who consistently win are not just reacting, they're anticipating. They know where value is building, where volatility is brewing, and how the larger flows are likely to play out before price even moves. That's not luck, it's context. That's what lets you move in sync with the market, not against it. That's exactly what I teach in the Context Builder program. I take you behind the scenes into how I read the market every day, from how I set up my charts to identifying intraday value, timing volatility shifts, and spotting key areas where big players are positioning. If you're tired of second guessing your trades and want a clearer, more structured approach to reading the market, this is what I built it for. You can check it out at hyvetrading.com. The truth is, trading isn't about winning every trade or having the perfect system. It's about understanding the bigger picture, making the right decisions over and over, and stacking probabilities in your favor. And remember this, the market doesn't care about you, but that's exactly why you need to care about it. Take what you've learned here, apply it to your own journey, and don't stop refining your craft. Because in this game, progression is the only edge that truly lasts.